Welcome back to Morning Trade Live. It's time to go inside out on Amazon ahead of this afternoon's report. Joining us for that is James Demert, founder and chief investment officer at Main Street Research. He joins me here at the desk. James, always good to have you. Thanks for being here.
Always great to be here, Caroline.
All right, so we're talking Amazon ahead of earnings. Shares actually higher heading into the report, up about 0.5%. Up about 8% so far in 2025. I want to get your expectations, and I think the key place to start is really cloud revenue, because Microsoft and now Alphabet are, I think, increasing the scrutiny on that number for Amazon. What are you expecting?
Yeah, all eyes are on that key number. It's web services, and the number everybody has to look at is 28.8. That's 28.8 billion. That's the expectation on the street. We think they're going to exceed it, even though Microsoft and Google came in low and the stocks got hit. Our view is they're going to beat on that. I think also, they're a little bit more of a veteran player in that business. So, our feeling is they're going to beat.
So, why Amazon beat, aside from being a veteran player? Now that we know, kind of where the weakness came from for Microsoft and Alphabet. What does Amazon have that they didn't?
And I think that's a really good point. I think investors sold the stocks down, the Googles, the Microsofts, on the idea that perhaps demand wasn't there. But if you read into those reports, which I think is really critical for investors, you see that this was not a demand problem, it was a capacity problem. They just didn't have the capacity to meet demand, hence revenue lower. And our view is Amazon's got their handle on that. They went into this quarter with enough capacity, and that will not be the problem. And we all know the demand is there for sure.
Okay, so a beat on cloud. Let's dig into some of the other areas of Amazon as well. We obviously know ad revenue, increasingly important for Amazon. What are the expectations there?
That's where we think, even if they missed a bit in the web services, we think they're going to make it up in the ad revenue. That's something that a lot of investors have not thought about very well. And the ad revenue is cooking along at about 20% growth. So we're going to want to see that continue, that momentum. We think it's going to happen.
Okay, 20% growth in ad revenue. And then what about the e-commerce side of the business? Kevin Hinks was on at the top of the show talking about how Amazon could overtake Walmart in terms of overall revenue. What are your expectations there?
Yeah, Caroline, I think we kind of forget Amazon, is in that business, which is their core business.
I don't forget it. You should see the amount of Amazon packages that I have at my house.
Land of cardboard. But, we're coming off of the fourth quarter of retail spending. It's going to go up on these numbers. So I think this Amazon report is going to be better than expected. I think people are on their pins and needles relative to Microsoft, Google. I think this is going to be the one that surprises the upside.
What about the loopholes that are being closed from the Trump administration that impact some of the boxes coming over from China? I know it expected impact Temu and Shein. Could that have a material impact on Amazon as well?
We don't think it's material,
Okay.
But yes, that is a negative. But we don't think it's a negative enough given all the other tailwinds they've got going on.
And could that actually help with pricing power? Should we expect prices to go up on Amazon if you can't get it cheaper at some of the competitor sites?
That's for sure. That's Econ 101. I think you're right on that.
Okay, so we'll have to keep an eye out on the earnings call to see if there's any commentary about tariffs. That seems to be kind of the topic of the moment. Also, CapEx, really key to so many of these big tech earnings that we've been hearing from. Most of the companies say they're continuing to spend and will likely spend even more than the street was expecting. What's the case for Amazon?
We think it's going to be the same. And the Google number at 75 billion, we think Amazon exceeds that, north of 80 billion. That's a run rate higher than 15%. So the arms race for AI is on and running fast. I think the DeepSeek information, true or not true, tells us that the technology for AI may get less expensive, which is typical in a technological transformation. The technology itself gets cheaper, the use cases expand, which is really good for Amazon.
So why would Amazon be spending more if the technology is less? I think, what if Amazon knows something that maybe we don't know, and they say, hey, look, we're going to spend less this year than is expected. What would the fallout from that look like?
Yeah, I think that's a dangerous assumption for them to make, and most companies don't do that because they want to make sure those prices are coming down before they withdraw that that spend, because otherwise what's going to happen is you're going to fall behind and lose that arms race which we're talking about. So I think you're going to have to wait to see, can there be some weakness in chip prices for AI, and then you're going to see, yes, maybe they'll keep the spending, but they're going to just be able to do more. Because the use cases are going to go up, so you're going to have to meet that volume. So I think the demand will stay the same, even though prices may come down.
Okay, James Demert, appreciate you breaking down all those key numbers for us. We'll certainly be looking for them. That's James Demert, founder and chief investment officer at Main Street Research. All right, let's trade it with Tom White, the co-host of Fast Market. So, Tom, you have an example trade for a more neutral trade for Amazon. James sounded pretty bullish in terms of his expectations, but what if someone's approaching it a little bit more neutral? Walk us through that example trade.
Yeah, a little bit more neutral, a little bit more conservative on this one, just due to the fact that the pullbacks what we saw in some of its major competitors in that cloud space. You mentioned Microsoft, $80 billion in CapEx this year. Google Alphabet, $75 billion. That was more than $15 billion than the street anticipated. And Amazon's CEO, Jassy, basically came out and said, we spent $75 billion last year. We're going to spend more in 2025. That might be a headwind. So I looked at something a little bit more conservative, going out to the February 14th weekly cycle. So not a pure earnings play. I'm giving myself an extra week on this one, where I'm going to sell an out of the money put vertical. It's still neutral, bullish in stance, but giving yourself a cushion to the downside. Selling the 230 strike put, and then against it, buy the 225 strike put. So a short $5 wide, neutral to bullish put vertical here. You're collecting roughly about $1.60 credit on it. That's what you can make, $160 per spread. That means you've got about $340 in risk, but your break even is all the way down at $228.40. That's over a 4% move to the downside before you start getting hurt on this trade. So this takes advantage of if the stock goes higher, stays where it is, or goes lower but remains above 230, you can be profitable, and you're taking advantage of that higher implied volatility level due to the fact that we have the event risk after the close today.
Okay, so shares up about 0.7% right now. What about an example trade where you need an even bigger move?
Yeah, this strategy takes advantage of some vol dispersion here that we're seeing, where the near-term options that expire tomorrow on the close, implied volatility levels are really elevated. So not having to pick a direction where, hey, this stock could maybe go and hit more fresh all-time highs, or maybe it goes down. The option market's pricing in about a plus or minus $15 move in the shares. That's nearly 6.5% either way. So I set up my strikes around what the option market's pricing in. Double calendar position going out to the February 14th weekly cycle, 8 days to expiration. I'm going to buy the 220 strike put, and I'm going to buy the 255 strike call. So you're buying those options in the February 14th option series. And then in the near term, Feb 7th weekly options that expire in just 1 day, sell those same strikes. Sell the 220 put, sell the 255 strike call. As a combination package on this double calendar, you're paying roughly about a 160 debit for it. There's your risk, $160. But you can see here from the risk profile, the apex of profitability is at or near that 220 strike or the 255 strike on the upside. So you need that move, that one standard deviation move. But you still have a nice wide range in this one, Caroline, between about 210 on the downside and about 265 on the upside, where you can remain profitable. What you don't want to happen on this type of strategy is you don't want the stock to sit here around the 237 level. You want it to move towards either one of those strikes, and you don't want one of those two standard deviation moves where, the stock goes up $30 or down $30. That's when you start feeling some pain on this one. But you're buying basically on implied volatility levels, about a 62% implied volatility on aggregate in the February 14th options that you're buying. You're selling about 137% implied volatility level on aggregate in the February 7th options. So there's that dispersion, which lowers the input cost and risk on this double calendar position. You just need a move, about a one standard deviation move either way.
All right, well, you talked about that 255 strike price. That's the median price target from analysts, obviously longer term, 12-month price target heading into this report. 94% of analysts rated as a buy. We'll see. Tom White, thanks so much for those example trades.
Thanks.